All right, now we'll begin. A great advantage of not having PowerPoints yourself is you don't have to worry about whether the PowerPoints are ready. But I wish you again all a good morning. I'm Alex Pollock of the R Street Institute, and it is a great pleasure for Desmond Lachman of AEI and me to welcome you all to our conference on Should the Fed Act as the World's Central Bank? Now, one might say that since the U.S. dollar continues as the world's dominant currency, and since it's a pure fiat currency, the Fed can't help being the world's central bank. It just is. But should the Fed act like the global central bank? Should the leaders of the Fed think of their problems and of themselves as carrying out the role of central bank to the world? How would that, and how should that affect their monetary policy, their rhetoric and communications, their actions as lender of last resort, and what they do with their massive bond market intervention? In general, how should global considerations affect the Fed's considerations, judgments, and decisions? The eminent financial historian Charles Kindleberger thought that there needed to be an international lender of last resort for the international financial system to work right. Is that the Fed? Should it be the Fed? And Paul Tucker, in a recent speech, considered the geopolitics of the current international monetary system. He traced the geopolitical roots of the current system to what he called a grand bargain between Britain, Europe, and the United States at the end of World War II, which was that the dollar became the world's reserve currency, a role once held, of course, by the pound sterling. And in exchange, Europe got to outsource its military defense to the United States, which it would help finance by buying and holding U.S. government debt. Now, this grand bargain put the Fed at the center of the international monetary system, and ironically, it became even more at the center after the U.S. reneged on its commitment to gold convertibility in 1971, which I remind you is already 45 years ago, this August. So, what are the Fed's international duties, if any, in the current international monetary system? One might maintain that its monetary hegemony cannot have legitimacy without corresponding duties. In Tucker's words, this argument is that Federal Reserve policymakers should place greater emphasis on the effects of their policy choices on the rest of the world. That is entailed by the responsibilities and moral duties the U.S. bears as the issuer of the world's reserve currency. Do we agree with that? Or do we embrace the opposite view, famously expressed by the then Secretary of the Treasury, John Connally, that the dollar is our currency but your problem? Well, we have an extremely knowledgeable panel today to consider these and related questions, and let me introduce them in the order in which they'll speak. First will be Steve Roach, who is a senior fellow at Yale University's Jackson Institute of Global Affairs and a senior lecturer at the Yale School of Management. Steve spent 30 years at Morgan Stanley, where he was chief economist and also chairman of Morgan Stanley Asia. His current research focuses on the impacts of Asia on the global economy, trade policy, the post-crisis policy architecture, and capital market implications of all of the above. Steve is the author of Unbalanced, the Codependency of America and China, and the Next Asia, Opportunities and Challenges for a New Globalization. Next will be Vince Reinhardt, a resident scholar at AEI and former director of the Federal Reserve Board's Division of Monetary Affairs. Vince spent more than 2 decades working on domestic and international aspects of U.S. monetary policy, including 6 years as secretary and economist of the Federal Open Market Committee. His research has included bubbles on the conduct of monetary policy, many aspects of the U.S. Treasury securities markets, the before and after of global and country-specific shocks, the policy mistakes leading to the 2007 to 2009 crisis, and the impact of central banks' quantitative easing. Then we'll hear from Charles Collins, who is Managing Director and Chief Economist at the Institute of International Finance. Charles previously served as Assistant Secretary for International Finance in the Treasury Department and as Deputy Director of the Research Department of the International Monetary Fund. He's published on a broad range of international macroeconomic issues, including not only World Economic Outlook reports, but the post-bubble blues, how Japan responded to its asset price collapse, managing financial crises, and India, economic reform and growth. Finally, Desmond Lachman, who is a resident scholar at AEI and the co-organizer of our conference today. Desmond has written insightfully and extensively on the global economic crisis, the U.S. housing market bust, the U.S. dollar, the debt crisis and strains in the euro area, currency issues, and the global macro economy. Previously, he served as Managing Director and Chief Emerging Market Economic Strategist at Solomon Smith Barney and Deputy Director in the International Monetary Fund. Desmond and I have had the pleasure of organizing numerous conferences together. We never seem to run out of financial disasters. I guess that's good luck from a think tank point of view, or out of questions about the role of the hegemon of the international monetary system, that is, the Federal Reserve. Each panelist will make opening remarks of 13 to 15 minutes. After that, we'll give the panel a chance to react to each other's comments or to clarify points. Then we'll open the floor to your questions, and we will adjourn promptly at noon. And with that, Steve, welcome, and you have the floor.
Is this working? Okay. I was told to push the silver button by you. Should the Fed act as the world's central bank? Provocative question. And, in keeping with my distinguished profession, I would say the answer, of course, is yes and no. And I'll try to take you through the compelling case on both sides of the coin. I will use some slides, if I can get to them. There they are. The one thing that you left off of my too lengthy intro, Alex, is that I started my life as a professional economist at the Fed, working with some characters in this room whom I'm delighted to see are still alive. And I have great fondness for the institution, but I sort of fear that the institution may have lost its way in the context of the question that you posed today. So I commend you for raising a provocative question. And I'd like to sort of frame my answer or answers in the context of a class I've been teaching at Yale for the last 6 years called The Lessons of Japan. Most of us, especially senior officials and senior staffers at the Fed, for years have harbored, I think, the rather arrogant and condescending view is that we in America, we're not as dumb as the Japanese. We understand the problems they made, that they encountered, and the blunders they made. And of course we have learned the lessons of Japan. And I shared that view for a long time myself, having been forced to drink the Kool-Aid at the Fed for a number of years on issues of denial like this. And I no longer believe that's the case. I do think there are some very Japanese-like characteristics of the current environment and the current policy environment as it bears on the answer to this question. This is just a simplistic set of things to think about in framing the question from the Japanese point of view. I think at the heart of the the question that bears on all central banks today are these really tough and very important political economy questions in interpreting mandates and in framing policies to implement their mandates. What is it that really shapes their choices on policy, on regulatory oversight, on supervision? And I would argue that the political economy of trying to achieve single mandates, dual mandates, or fuzzy mandates is a very important consideration. I think this notion of the policy trap, which I'll come to in a second, is really important. Having dipped a toe or two in the water, that sometimes central banks just get in so deep they can't get out. This notion of financial engineering, or as the Japanese would call it, cited, using increasingly complex instruments to convert asset-dependent economies into recipes for dangerous and unsustainable economic growth, is a characteristic that many of our Japanese-like economies have in common, which leads to this preponderance of uneconomic entities called zombies that have lasting impact on underlying productivity. And again, this notion of getting out of the quagmire, the so-called exit strategy, which we're all grappling with today, is endemic to the lessons of Japan as they bear on other economies around the world, including our own. This is a little bit more of a detailed assessment of this construct from the standpoint of four economies: Japan, the U.S., Europe, and China, breaking down the bubbles that get formed by reckless policies, their distortions on the real economies, and the zombies that come out of the bursting of the bubbles and their lasting impact on the distorted sectors of the economies. The framework is different. The mechanism by which these issues play out on the economies are different, but they do lead to large swaths of each economy that remain under lasting pressures in terms of performance and solvency. You tell me. I mean, is this just a coincidence? This is just GDP growth over selected periods to make the chart look dramatic. But, Japan, the great growth miracle that it was for 45 years is not exactly conformed to past performance. Neither is the United States, neither is Europe, neither is, my favorite economy in the world, which Des is going to trash shortly, I think. There's slowdowns everywhere, and the question is is this a pattern that the World Central Bank needs to be more cognizant of in terms of understanding the role it plays in the conduct of monetary policy? My key premise is that where central banks have gone astray is in fighting yesterday's war, inflation. To target inflation in an inflationless world is ludicrous, I think. And yet that's what they're all doing, locked in this sort of Bernanke mindset that, if you hit your price stability target, everything else from the standpoint of growth, efficiency, productivity, income distribution will be fine. And a global central bank needs to do a better job of understanding the global pressures bearing down on inflation. There's no central bank in the world right now that's even close to hitting its inflation target. And by framing policy, I'm going to check my watch, by framing policy in the standpoint of these narrow price targets, in some cases set arbitrarily, really a danger of missing some of these very powerful global forces. Two central banks, U.S., Japan, real policy rates. See for yourself. These are policy rates that are adjusted for the ups and primarily now the downs of inflation. And you can see the the difference in the last 15 years compared to the prior 15 years. The Fed is actually much more aggressive in pushing down its real policy rate in the last 15 years relative to the prior 15 years than the BOJ was. But both central banks, of course, no longer have any ammo in terms of conventional policy tools. So they've discovered the joys of quantitative easing and the miracles of taking steps that none of us ever dreamt with their balance sheets. And of course, there the Bank of Japan is in a unquestioned league of its own. What emerges from this, though, is creative policy with no impact on the economies by which the central banks are being charged with managing and addressing. The argument in favor of central banks is, oh, God, if they hadn't done it, it would have been so much worse. I really have huge issues with the integrity of the counterfactual in this case. I think strategically, if I was to be critical of central banks around the world, especially our own, of which I have great historical fondness for, which I've said before, is in mistaking the policies that were deployed during the crisis for the right strategy to foster economic recovery. Lender of last resort in a crisis is exactly what needs to be done, but to continue to stay in that mindset when the crisis is over, I think is of dubious merit. Here's Japan. You can see for yourself now 25 years of less than 1% growth. We celebrate the power of Abenomics and what they call QQE, quantitative and qualitative easing. And let the record show that 3 years into this noble experiment, the growth rate, I was going to use a bad word, is bad. It's even less than half that during this Koizumi era, when the reforms were actually closer to being impressive. What about the U.S.? Again, the shaded blue bars are our recovery, which is averaged about 2%, which is about 2 percentage points short of the historic norm. And yet, needless to say, the Fed has been extraordinarily aggressive in trying to recreate the cyclical vigor of yesteryear. In my view, the problem here is one that goes back to the sort of the Japan diagnosis, the balance sheet recession, as it's been called by Richard Koo, which clobbered American consumers, which are still in the process of repairing the hole in the balance sheet that opened up during the financial crisis. Consumption growth for 8 years has been about 1.5% per year, the weakest period of consumer demand, certainly in our modern history. As I said earlier, we continue to dig ourselves deeper and deeper into the quagmire. Weak GDP growth in a low inflation environment has led to an ever-ending cycle of monetary accommodation and increasing government indebtedness, probably not enough government indebtedness in a low interest rate environment. Vincent's the expert on debt cycles. I'll leave that to him to comment on. But from my point of view, the interesting observation is that central banks, by grabbing the reins of post-crisis stimulus and creating a lot of froth in markets that makes politicians delighted with the euphoria expressed by investors, takes the heat off of the real remedy in these post-crisis environments, and that would come through more aggressive fiscal policy. And that's certainly the case in Japan, but it's also the case in our country. Let the record show that the third arrow of Abenomics, getting back to the lessons of Japan, is still in the quiver, because the BOJ and Governor Kuroda has seized the agenda and has been unable to shake Japan loose, just like a quantitative easing has been unable to shake America loose. So I think the answer to the question, Alex, is that central banks need to be much more aware of the globalization, of the problems they face. Their mandates are set, however, by their national legislatures, so they need to act globally, but stay very focused locally on what the messages are from their economies. I think we're in a really significant period for the rethinking of the strategy, the tools, and even the mandates of monetary policy. And my bell just rang, so I'm going to stop on that point. But with the notion that maybe this political season that we're all trying to desperately survive will also force us to rethink the art and science of central banking to come up with a more effective answer to the question that you posed at the outset. So I'll stop on that.
Thank you, Steve, and thank you for being a speaker who's got his own time warning. That's very welcome. Vince.
Thanks, Alex. Thanks for inviting me, and thanks to you too, Des. I, too, will start with a confession. I did, in fact, drink the Kool-Aid, too. Not only that, there were on occasions I mixed it from the package and poured it into the happy-faced pitcher. And that's why this is a tough topic for me to address, and it helps me to be somewhat formal in addressing it, because I think there are three key questions about the Fed as the world's central banker. First, can the Fed do it? That is, do the instructions in the law allow the Federal Reserve to act as global central bank? This is really a question of governance, because an independent agency should not create its own mission. It should be given to it by the Congress. Now, whatever the law and however poor congressional oversight may be, we should also ask the question, has the Fed already been acting as global central bank? And in that sense, we have to think about all a central bank does, that is, both as a crisis manager and in setting, implementing, and communicating monetary policy. And then third, when we get to the point that we can ask, should the Fed perform the role? And I'm going to come to the conclusion is the Fed has acted in a way that raises governance issues, but it should act within the global context to better fulfill its domestic mission. Now, why there might be overreach is perhaps why there's been central bank mission sprawl across the major industrial countries. Is another question for the panel, really. If it weren't the Fed, who would have done it? And that's why central banks are in the position they are today. So, first issue is, let's look to the law. And the clearest exposition of the Fed's mandate was written into the Federal Reserve Act in 1977, which says the FOMC shall maintain long-run growth of the monetary and credit aggregates to increase production so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. That is a domestic mission. And if you go to the next set of instructions given to the Federal Reserve the year later in what was, what's known as the Humphrey-Hawkins Act, it's 40 pages of an entirely domestic-centric set of instructions to the U.S. government and its agencies to pursue policies to best best effect for its citizenry. So the conclusion is any sensitivity to the rest of the world has to be derived from the effect of the rest of the world on the pursuit of the Fed's domestic responsibilities. And that is a question of governance. But let's look to the practice. Well, central crisis management, including lending to foreign central banks in 2008 and 9, up to almost $2/3 of $1 trillion to the major central banks, including $170 billion at the peak to the ECB, another $75 billion to the Bank of England, and $50 to the Bank of Japan. That was an extension of credit to the rest of the world, but it wasn't just to central banks, it was also to foreign banking organizations. The Federal Reserve was a very large lender to the banking system, and it just so happens that foreign banking organizations were the majority participants in many of these programs. If you look to the term auction facility, 19 of the top 25 institutions bidding for long-term discount window credit were foreign. 13 of the biggest top 25 borrowers at the discount window in that time were foreign banking organizations. 15 of those seeking to fund commercial paper through the discount window were foreign banking organizations. So the Federal Reserve provided dollar liquidity at a time dollar liquidity was needed. That is, as in the left panel, the Fed provided dollar liquidity to foreign central banks, presumably so they could on-lend to their depositories and to foreign banking organizations directly. I'm not saying that was the wrong thing to do, but consider the logical alternative that would have the same balance sheet consequences. The Fed could have been one that said no, and foreign central banks would have had to provide home currency funding to their depository institutions. Those depository institutions had a dollar problem, not a home currency problem, and so they then would have had to purchase dollars on the foreign exchange market. That would have put upward pressure on the dollar of an immense magnitude, and the U.S. Treasury would have had to intervene to prevent that, the extent of that appreciation. Same net effect, those needing dollar liquidity would have gotten dollar liquidity. In the one, the Federal Reserve did it itself. The Fed-free alternative had a clear governance structure, and the Treasury would have had to justify foreign exchange intervention to the Congress. The Fed alternative was opaque and without as clear a governance structure, and it resolved an awkward political problem. I think Charles could vouch that no Assistant Secretary of International Finance would have wanted to get that phone call that necessitated intervention. The issue isn't whether it was the wrong thing to do, it's who is the Fed reporting that to. So anyone considering an expanded role for the Fed should also elucidate an expanded scope of Fed governance as it performs that role. Now, as to implementation, I want to remind you, we have in the United States, have a central bank with a very big balance sheet, about $4.5 trillion of footprint in global finance, and about $2 trillion of that is reserves. Well, about a third of that is held by foreign banking organizations. So when we think about the Fed paying interest on deposits, when the Fed operating large reverse RP transactions, it is importantly with foreign banking organizations. That's a consequence of the dollar being the global currency. Now, as the conduct and communication of policy, I'm inclined to believe what they said. And on March 16th, they said that the outlook was clouded by the global economic and financial developments of recent months. And at the last FOMC statement, they said that they would closely monitor inflation indicators and global economic and financial developments. So we have elevated that dual mandate of maximum employment and stable prices and included global economic and financial developments. Well, that's how they said it, but I think they said it poorly because you really want to look to incentives. Why might the Fed be acting with such a global outlook? And the reason you want to look to incentives is I believe the last unselfish act of U.S. foreign policy required the exercise of the moral authority of George C. Marshall. I don't see him in Washington anymore. And so why might he might be coming out of his grave? And, why might the Federal Reserve have such an external focus? And I think a syllogism drives Fed thinking. Any factor, there's some arrows missing from this picture. Any factor X that influences aggregate demand, inflation, or the transmission of policy is a factor that influences the setting of Federal Reserve policy. If your ultimate goal is aggregate demand and inflation, and factor X influences the financial market reaction to your policy decision, or directly influences aggregate demand and inflation, you have to take that into account. We could just as well have a session, is the Fed too equity market centric? And I'm sure you gentlemen probably have organized those sessions and will in the future. And the answer is, if household wealth importantly includes equity values, the Fed has to take into consideration equity values. The exchange value of the dollar importantly influences aggregate demand and inflation prospects. It therefore has to be taken into consideration in the pursuit of the FOMC's goals. And I think importantly, global financial considerations influence the market response to Federal Reserve policy actions. And I use that to explain a puzzle empirical macroeconomists will have in 10 years. When they look at standard readings on the US economy in retrospect, it will be hard to understand why a Federal Reserve that tightened monetary policy in December of 2015 didn't tighten monetary policy in September of 2015 or March of 2016. What was different? And I would argue what was different was after December, they learned that there's scope for an outsized market reaction to their policy actions. And that outsized market reaction importantly includes what happens in foreign financial markets and the exchange value of the dollar. In that environment, when you are more uncertain about the effects of your policy on your goals, you should attenuate. You should take smaller steps and take longer to get there. So, having announced in December their intent to tighten 4 times, they learned that that could lead to a large swings in markets, and they went from 4 to 2. They attenuated. That is why you closely monitor foreign financial markets. That is why you include that in the FOMC statement, because it is influential in the pursuit of your domestic objectives. As to, boy, this is getting, when you think about the conduct of policy, recognize the upper left panel sort of was supposed to show that the rest of the world matters because there's more rest of the world out there. That gives the sum of exports and imports as to GDP. So when Steve or I were at the Federal Reserve, yes, the rest of the world mattered importantly, but there's more GDP at stake than before. Moreover, don't be misled that the Fed's pursuit of its domestic objective also seems to be in sync with the performance of other macroeconomies. Why? Because in the shaded area represents the distribution of the correlation of 190 countries' GDP since 1980 to US GDP. Mostly everything is to the right of zero. Most countries are intimately connected to US. What the Fed does will be correlated with what happens in the rest of the world. Here it is. Okay. And increasingly so because there is more rest of the world. So my bottom line is, yes, the Fed should take foreign considerations into in setting and communicating its monetary policy, but there are important governance issues that are unresolved in the way it implements its policy and in the way it acts as a crisis manager.
Thanks, Vince. Charles.
Thanks very much. It's a pleasure to be here and an honor to be on such a distinguished panel. Great provocative question. I think I have broadly the same answer as the other panelists so far. Desmond may yet surprise us. But I think I'll come with a somewhat different route to the answer. Basically, I think the answer is no. The Fed should not act as a global central banker, but it should act as a responsible global citizen. The first responsibility of a global citizen is to keep your own home in order. And I think the Fed has actually been quite successful at that in the post-crisis period. I never worked at the Fed. I was invited to lunch from time to time at the Fed, but I don't think I ever drank the Fed Kool-Aid. But even so, I think
There's some on the back table.
there's some at the back there. Maybe I really did without realizing it. I think the Fed acted very aggressively in the face of a deep recession and a massive financial crisis, and managed to turn the U.S. economy around. And while we are not yet back at 2% inflation, we're actually not very far from it, and the Fed is beginning to unwind the extraordinary measures. So I give plaudits to the Fed on that account. But it's certainly the case that the Fed's actions did have some negative spillovers across the world. Now, first and foremost, the fact that the U.S. economy was restored to health is a huge global benefit. But certainly there was some pushback, particularly during the QE period, from policymakers in emerging markets who were seeing a flood of capital flows into their economies. Most prominently, I guess, Guido Mantega, finance minister in Brazil at the time. More recently, Raghu Rajan, the governor of the RBI, Reserve Bank of India, emphasized the difficulties of managing their own policies in the face of a flood of capital flowing into their economies as a result of very aggressive asset purchase program by the Fed and subsequently other central banks. At the IIF, we follow very closely capital flows to emerging markets. During the period 2010 to 2013, we had non-resident capital flows to the emerging markets of around $1.2 trillion a year. And much of that was in portfolio flows and increasingly volatile portfolio flows that were driven by the ebb and flow of QE1, QE2, QE3. The emerging markets at that time saw their exchange rates under great pressure. They were very concerned that overappreciated exchange rates would do damage to their export sectors, which from a long-term perspective is extremely negative for them. Most emerging markets therefore resisted the exchange rate appreciation by intervening heavily, but intervention led to very rapid credit growth, which I think Desmond may be coming to later. It led to inflationary pressures, it led to excessive indebtedness in their economies, so that's not too good either. And in some cases, countries introduced measures to try to resist the capital inflows, capital flow measures, sand in the wheels, macroprudential, a variety of different measures, but none of them were particularly effective. And if they were effective, for probably only a very short period. And I think there is a concern that they do long-term damage to countries' financial systems. So really no easy answers for these countries. There's also a problem on the outflow side. As the Fed has moved to tighten, that creates certainly the possibility of volatility. We did see a period of stress in the summer of 2013, the taper tantrum, when Fed officials started to talk about winding back asset purchases. Now, in practice, when the Fed actually did come to unwinding, running down the asset purchases, and when it did finally increase interest rates for the first time in December, those were absorbed by the market pretty smoothly, as they had been well signaled in advance and well anticipated by the market. But I think there are certainly risks going ahead that we could see difficult times as the Fed goes further towards raising rates. Even with the dialing back of the pace of tightening that Vince mentioned, the Fed is still communicating, the FOMC is still communicating that it anticipates that 6 interest rate hikes will be appropriate in the most likely scenario by the end of 2017. At this point, the market is very skeptical of that and only is pricing in 1 interest rate hike. The difference between those two is very wide and could lead to very turbulent market conditions. So what should the Fed be doing going ahead as it goes through this difficult period? I think first and foremost, as I started with, the Fed has to make sure that it's doing its job in terms of meeting its domestic mandates. There's no question of that, and ultimately that is the best for the United States and is best for the global economy. But I think there are a number of aspects of its behavior that can be tailored to make sure that the global impact is most positive. I've mentioned 4 aspects in particular, two of which are pretty much standard planks of modern central banking. One is really a continuation and expansion of the G7 cooperation agreement that was put in place a few years ago, about 5 years ago. And then finally, a more controversial area, which is the area of whether there should be a lender of last resort. On the 2 standard planks, one is a point that Vince emphasized, the need for the Fed to take due account of spillovers of its policy on the rest of the world. And as Vince emphasized, the reason the Fed has to do that is because increasingly the rest of the world is spilling back onto the U.S. economy. As the global economy and the global financial system become increasingly integrated, financial shocks in particular are communicated very, very rapidly. And I think it was appropriate for the Fed to step back in September 2013 to slow the pace of tapering, to step back in September 2015 to slow the pace of raising rates, and similarly in early 2016 to slow the rate of rates at that time. So I think that's a lesson that has been appropriately learned. Number 2, communications. Certainly the Fed is fully aware of the need to communicate coherently and effectively with markets. It's done a better job since the taper tantrum. It avoided turbulence surrounding its first rate hike, as I mentioned earlier. But it is very difficult. This is a time when there's a huge amount of uncertainty about what is the true underlying characteristics of the U.S. economy. Where is the Phillips curve? How flat is it? How bad is U.S. productivity growth? Will we see any recovery in the period ahead? What about the U.S. participation rate? There's been a recent rebound. Will that be sustained? These are critical question marks for the Fed as it considers the appropriate pace of monetary tightening, and it can't commit itself in advance to any particular path. It needs to be data dependent. So it's going to be tricky going ahead to be able to do the right thing without, at some point, providing at least a little bit of market surprise. Third point, and probably the most interesting point, is the cooperation between the Fed and other central banks. I think there's a fair amount of misunderstanding here. I think coordination, in the sense of actually having quid pro quos, I'll do this if you'll do that, is something that central banks cannot do. There was some talk after the G20 meeting in Shanghai that there had been some secret Shanghai Accord, akin to the Plaza Accord, perhaps, of 30 years ago. But I think that's nonsense. Central banks don't have a basis. They are legally mandated to pursue domestic objectives. There was no secret Shanghai Accord. But I think what did happen was that the central bankers reaffirmed their commitment to an understanding that has been in place for about 5 years now. And I think they also included within the group of leading central bankers the PBOC, and that was the crucial step. The G7 cooperation agreement is basically that central banks will pursue domestic objectives using domestic policy tools. They will not pursue exchange rate objectives, and they will not use external tools to achieve exchange rate objectives. And I think that's based on the well-founded view that trying to use exchange rate tools is a reshuffling of demand at best at a time when there's a global deficiency in aggregate demand, and reshuffling really does not help. It's counterproductive. So I think the crucial additional ingredient that came out in Shanghai was that the PBOC joined in this effort. The PBOC had been very quiet for a long period of time, despite the turbulence and uncertainty around China's monetary and exchange rate policy. The PBOC came out much more clearly that it would avoid trying to depreciate its currency, the RMB, for competitive purposes, and that it would find other means to support the economy. In particular, they have moved some fiscal support through the economy, which has helped support demand. At the same time, the Fed has followed through with a pretty dovish set of remarks consistently since then, recognizing the external impact of its activities and the fragility of the global environment. So it's not surprising that consistent with what I had said earlier, that the Fed has been very concerned about potential spillovers and spillbacks at a time of fragility and uncertainty. And finally, you also have the ECB and the Bank of Japan in particular stepping away from a relentless pursuit of cutting policy rates into ever more negative territory over the past couple of months. The ECB in particular has been quite aggressive in exploring credit easing tools rather than just lowering policy rates. And I think the main motivation for that is an increased understanding that cutting policy rates is largely effective, if at all effective, through its impact on the exchange market, which is not good in a collective sense, as well as concern about the damage that it does to the domestic financial system. So I think this broad approach actually has been fairly effective over the past few months in stabilizing markets, generating a rebound in market sentiment that, at least for now, has reduced concerns about tail risks and is underpinning a global economy that remains pretty fragile. But I have to say I am quite concerned going ahead that these good times may not last, because at some point the Fed does have to shift out of this extreme dovish mood into actually raising rates again as labor markets tighten. It's going to be difficult to calibrate exactly what the timing of that and the trajectory of that will be, but at some point over the next year that has to happen. And I also have some concerns about China's stimulus and how long that will last, and the longer-term consequences of continuing to pile up debt. Finally, the global liquidity safety net. As Vince said, in the period of the global financial crisis, the Fed was very aggressive in establishing dollar swap lines to ensure adequate dollar funding at a time of extreme stress. In the end, it set up a network of around 14 central banks around the world, including 4 central banks that are usually characterized as emerging markets, Korea, Singapore, Mexico, and Brazil. Subsequently, however, those swap lines have been discontinued. At this point, there's just a group of 5 core central banks that have swap lines, but none of the emerging market countries have swap lines. And I guess I can understand why the Fed wanted to pull back these swap lines as it did. It puts the Fed in a difficult position to have to choose between countries. There are a number of other countries that wanted access to swap lines that had to be denied, countries like India, Indonesia. And it also puts the Fed in a difficult position when a country that does have a swap line behaves in such a way that the Fed actually has to pull back the swap line. So Brazil would be a good example of a country that was given a swap line 6 years ago, but I don't think at this point the Fed would be inclined to give Brazil a swap line, even in a more difficult global environment. There's also concern that these swap lines could expose the Fed to credit risk, and concern that the political environment in this country at this point is not too thrilled about that prospect. So I don't think the Fed by itself can be a global lender of last resort, even in dollars, to the extent that one is needed. And I think, therefore, there may be a room for the IMF to play that role, but with the Fed providing very strong support for it. In fact, this is something that has been pushed recently by former IMFC Chairman Tharman, by the IMF Managing Director, Madame Lagarde, as well as Raghu Rajan himself. And I think what this does is it outsources the difficult choices about which countries can be included in the circle, the virtuous circle of countries that actually merit receiving short-term credit on very easy conditions or no conditions in large amounts for a short period of time to the IMF. It also allows the IMF to take on any small amount of credit risk that is involved. But I think the Fed would still need to be a key supplier of funding to provide a backstop to the IMF to make those liquidity lines fully credible. I'll stop there.
Thanks, Charles. Now, those of you who have been here before know that Desmond has a special role in these conferences, which is to bring us the good news. So, Desmond.
Alec, thank you for that introduction, and I hope I don't disappoint you all. Being the last speaker, I really do agree with a lot of what has been said by the previous speakers. And especially I agree with, Vince's formulation of the Fed's role is that it should be based on domestic outcomes, but it does have to take into account how the global economy might affect those domestic outcomes. It also has to take into account how its policies might affect the global economy, and then the loop back to the Fed. Now, where I disagree is in terms of assessing, what the Fed's role has been in looking at the global economy in the last few months. And I'm really just struck how the Fed changes its view on the global economy, every meeting. September, they tell us that the global economy is really in bad shape. They can't raise interest rates. But December, they tell you it's just fine. They raise interest rates. There's a little market turbulence in January, so they tell you the global economy is really a concern. And then the latest meeting, they shift yet again. And, to me, that strikes me as really just missing the point, because I think fundamentally there are factors that should be of concern to the Fed, should be of concern right through this year, and that should forestall the Fed about raising interest rates anytime soon. So really the things that I'm concerned about, and I would have thought that the Fed should be focused on, is firstly, it seems to me that the world is drowning in debt. Secondly, it seems that there's a confluence of risk factors that we haven't seen before, that in very many parts of the world there are things that can go very wrong. And the third matter of concern to me is that policymakers seem to be running out of ammunition across the globe, so that if anything goes wrong, we could be in trouble. So all of that would incline me to think that the Fed should be a lot more concerned about the global economy as it might impact the United States, and they shouldn't be in that much of a rush to begin continuing raising interest rates. So let me just elaborate on those points. The first, that the world is drowning in debt. That McKinsey did a study a little while ago showing that debt in most parts of the world is significantly higher today than it was on the eve of the 2008-2009 recession. We've just seen debt increasing everywhere. Where I'm concerned is that there are a bunch of real weaknesses. The first is in the emerging markets. You've got corporate borrowing there. This red line is just showing you that corporate borrowing in the emerging markets has doubled from something like $10 trillion in 2010 to something like $23 trillion at present. $5 trillion of that is in US dollar-denominated debt. This is a corporate debt in emerging markets, places like Brazil and so on, that can be a real problem. The case that, not to disappoint Steve, the case that really bothers me is China. This chart shows the increase in China non-financial private sector debt. The red line, you just see the trajectory of that red line over the past 6 years, and you compare it to what happened in the United States, before its housing bust, and Japan before its lost decade. You just see that China is really in a dangerous position. The next chart just reminds us, not only Japan, but the Mexican peso crisis, the tide crisis. You just see what's happening with the red line on China. It's exceeding the rates of credit expansion elsewhere. I would think that that really has to give one some pause. Europe, of course, the sovereign debt crisis began there in 2010. 6 years later, with all of the efforts that they've made, we've got debt levels that are higher in relation to GDP than before. Places like Italy, 130% of GDP. This is telling you that you've really got a debt problem. And of course, I don't want to forget Japan, where the IMF is saying on present trajectories, they're already at something like 240% of GDP. They're on the way to 300% of GDP. That would give me pause. Now, the second point I made is that there's an unusual confluence of risks. One can really go into the different parts of the world. You could devote a seminar to probably each of the topics. But Europe is certainly far from out of the woods, despite all of the tailwinds that they've got from low interest rates, a depreciated exchange rate, low oil prices. Their recovery is pretty pathetic, that they've just now regained the level where they were in before 2008. But places like Italy, Spain are something like 6% lower. Aside from that, you've got the real risk of Brexit. We've got a referendum in June. I would have thought that would give the Fed pause. If the Brits make the mistake of voting to leave the euro, we're really going to have a huge sterling crisis. I'm not sure that the Fed wants to raise interest rates ahead of that. That would be a great mistake. And then Greece, the perennial problem, it looks to me political, and their position with the IMF isn't too encouraging, so you really can't exclude a Brexit. This chart is just showing you individual countries since 2007, Greece, Italy, Cyprus, Portugal, Finland, Latvia, all of those countries are significantly below they were 8 years ago, which is a problem if you've got very high debt and you're now moving to deflation. Italy's debt is really the place that should keep one awake at night. We're now at 130%. So this place is can't grow. It's really a problem at some stage. And of course, the banks in Italy aren't in the greatest of health. So you've got another risk there. So much for the European risks. Japan is got a real problem, debt problem. I'm not sure that I understand the strength of the yen right now, but I should imagine it's not too healthy for Japanese debt dynamics. China, as we've mentioned already, it's already slowing. It's got a lot of debt. What I'm concerned about China as well is China has got a real capital outflow problem. Hopefully that's abating. But it really has to be concerned, when a country is losing something like $1 trillion, when it's slowing a lot. I wouldn't exclude the possibility that they're going to have to use the exchange rate, and that could be really very complicate matters in the global economy. Just as far as emerging markets, they've been hit by really low commodity prices, by reversal of capital flows. And the place that one really has to be concerned about, not least because it's the largest economy in Latin America, is Brazil, where it looks like it's in a political and economic downward cycle. That they've got this is just showing that GDP has fallen by something like 8%, point to point, and showing no signs of that process ending. And then the country's debt burden, at least the country's deficit has now gone up to 10-11% of GDP, with debt moving from 57% to 80% in a short space of time. That really has to be of concern. So looking at all of that, it would strike me that the chances are that you are going to get an accident somewhere. There's just far too many things going on that it could really trigger a crisis with a lot of debt. It's a problem. And then we've really got an issue of what else do you do now? You've used quantitative easing. Negative interest rates don't seem to be doing too much good. There's a lot of restraints on the fiscal side. So for all of those reasons, I would think that the Fed should be a lot more cautious about how the global economy might be impacting the United States.
Thanks, Desmond, and thanks to all of the panelists for a really interesting set of discussions. Now, what I want to do is just go back down the panel in the same order for anything else that each wants to say about comments on somebody else's position or further elaboration of their own thoughts. Let's say 2 or 3 minutes, 4 minutes maximum. Steve?
Well, I like the conclusion that we offer about sticking to your own knitting, but being a good global citizen while doing that. But I think Desmond's final point of what does good global citizenship look like in today's mark-to-market environment, and why is the Fed see the world through rose-colored glasses one month, but then through dark glasses the next month, and then keep switching back and forth. You know, what is the Fed trying to tell us here? I just heard the word average muttered in the from the audience, and you know, I always remember this. Mike, you might remember this too. The great axiom of Chuck Partee's law. That actually somebody else took credit for that too. Recently at a Fed retirement function that I attended, Partee never could sort of decide between the left hand and the right hand, so he just averaged the two and came up with sort of a middle of the road prognosis. I'm not sure that really works in this precarious global environment that we're in right now. The other point that I would raise questions about is, this debt issue, and I'd really sort of push Vincent to elaborate a little bit on his thoughts on this, having spent so much of his time, working on this issue, and what debt overhangs mean for the long haul. It's pretty clear right now that the buildup of debt's extraordinary, but the consequences of that are being underwritten and subsidized by zero or negative interest rates, and so there's no real consequence for debt overhangs until or unless or if ever we go back to normal interest rate in environments. One of these days we're going to get there, and you guys, you'll probably be around to hold conferences about, the new realities of normal interest rates. But that conference is not going to happen for a while. But with debt at the level that it's at right now in the developed economies, as well as in one of these in so many of these large emerging markets economies, how are we going to deal with that? What is the role of a central bank to normalize policy in the context of these debt overhangs? Will it ever be able to do it? And if it's not, what are the consequences of that?
That's right. How can you take away the punch bowl when you're the guy bringing in more rum to put in it all the time? Vince.
I am confident at that future conference in a renormalized world where all economies are growing and balance sheets pristine, Des will find at least a dozen reasons why we should all be worried. I'd just like to make a couple points, and I agree with where I see the Federal Reserve over the last several months is a problem in communicating. That in December, it put forward the intent to raise rates 4 times in 2016 in an environment, as Charles has pointed out, markets were uniformly more dovish about the prospects for Federal Reserve policy, have been over Janet Yellen's entire tenure. The response was outsized in global financial markets. Having learned that, the Fed scaled back its plans. That's appropriate, but no one likes to admit a mistake. And so rather than saying there was an outsized reaction to our action, we're scaling back, they talked about a level shift in foreign economic activity, and they actually became a coordinator of pessimism about the global economy. And so I think that importantly explains the moving back and forth in the FOMC statements. The second aspect that you have to appreciate about Fed policy is if you actually only plan to tighten 2 times a year, then at any single meeting, it's tough to get that high a probability of acting at that meeting. And if it does turn out that that the two most prominent members of your committee, the ones that market participants look to for guidance about what will happen at the next meeting, are probably among the most dovish of those FOMC participants. You realize that tightenings are planned, and the key problem in a plan is you can always trade off your action today for action in the future. Doing something today could be also accomplished tomorrow, and sometime you may run out of tomorrows. So I think that's an important Federal Reserve challenge. The third part of the challenge is we have to wrap our minds around the idea that advanced economies aren't growing that fast. We're all getting older, population growth is slowing, and for some reason, productivity growth has slowed markedly. 6 of the 7 G7 economies has seen the IMF mark down their estimate of potential output growth over the last couple of years. That says something about where rates will settle ultimately, but it also says something about, to Steve's point, debt burdens. The rate of growth of potential output in an economy is also the rate of growth of future income. And households and governments borrow on the expectation of a path of future income. That's their debt-bearing capacity. And if growth slows, it has a large level effect on your debt-bearing capacity. And you probably don't learn it all that quickly. Remember, in the US, economists understood that productivity growth slowed markedly in 1973 in about 1980. In between, you stretch your balance sheet and then come to a realization that you're over-levered. And in an environment of over-levering, you have two choices. You either grow more slowly for a long time, or you have a crisis. And so part of that renormalization of monetary policy has to take into account rates are going to settle at a lower level, and that road's going to be bumpy.
Can't you have both, a crisis and grow more slowly for a long time?
You'll probably do, many economies will do both.
Thank you. Charles.
I'll pick up on Vince's last point there. The consequences of weak supply-side performance in the U.S. economy. I think that's a reality that we're all increasingly recognizing for a variety of reasons, demographic reasons, productivity reasons, more global reasons too. The fact that China are the big engine over the past 10 years itself is going to be forced to slow. But I think one consequence of the weaker supply-side performance in the U.S. economy is it puts the Fed in a very difficult position because although there are all these global fragilities that Desmond laid out, it may well be that the U.S. economy is getting very close to the point where slack is being largely absorbed. It's hard to calibrate because it's certainly the case that we haven't seen a big pickup in wage pressures yet. On the other hand, the unemployment rate has come down very far. Broader measures of the unemployment rate are coming down too. Over the past 6 months, things have got a little bit of relief from a pickup in the participation rate, but it's not at all clear whether that pickup can continue. I think many people think that it's a temporary feature, and there's certainly risks that we could see over the next year a pickup in price and wage pressures in the United States, despite weak global growth. And I think that the Fed is justifiably concerned that at some point it could be seen as having fallen behind the curve and having to actually hike rates for domestic reasons at a rate that would be quite damaging, both for the U.S. economy and globally. So while it's attractive to be dovish from a global perspective, it may actually not be the best thing for the Fed to do as a good global citizen if it means that the Fed actually has to be a lot more hawkish next year and precipitate a much nastier global outcome. So that's why I sort of go back to my sort of first principle that while being a good global citizen, you need to make sure that you get your domestic house in order first.
Desmond.
Yeah. I guess I just want to address that debt overhang problem and just outline, why I'm not quite so sanguine as Steve seems to be about it. Because even though you might have low interest rates being set by the main central banks, that doesn't mean that spreads won't blow out as soon as people cotton on to the fact that a lot of these countries are on a totally unsustainable path. And as soon as that occurs, it doesn't matter that the ECB or the Fed has got the interest rate at zero. If the spread at which Brazil or Italy is having to borrow begins rising, you've already got a problem. And you've also got a problem if you get capital reversals, that we've seen to a large degree. Countries got big deficits like Brazil. Money begins coming back to the United States, which would be accelerated if the United States raised interest rates. So, for those reasons, I think that the debt overhang, at some point, the chickens will come home to roost. And my concern is the fact that you've got fragilities all over the place. All it's going to take is one accident, and the whole house of cards could really come down, and hopefully we don't see that, with something like Brexit, which is the most obvious. Let me just say one other thing is, Steve mentioned a point, that he didn't understand why central banks insist on inflation targets at a time that we don't have inflation. Well, I would have thought that we want inflation targets now so that we don't have deflation with all of this debt going on. So, I think that that's a very good marker for the central banks, that they're falling short of their 2% targets, makes it very difficult for Italy. How is Italy going to get out of this debt trap if there's deflation in Europe on top of no growth in Europe? That is when the whole thing comes apart.
If we understood that right, the reason to want inflation is the debt. The reason Steve said to want low interest rates is the debt. And I think, Vince, the reason why growth is so poor certainly involves the debt. So the large debt in existence, which we have watched build up, certainly is a huge force in all this. I have a question for the panel. My friend Bob Aliber, who has 2 or 3 times updated Charles Kindleberger's classic on manias, panics, and crashes, has pointed out that back in the days when people used to believe in fixed exchange rates, and the revolutionaries were the floating exchange rate school, they argued that floating exchange rates would be stabilizing, and that the speculation in exchange markets would be stabilizing, and that the great advantage was that then central banks, presumably including the Fed, would only have to think about their domestic economies, and everybody could do whatever they wanted to as far as the domestic economy, and the exchange rates would float, and everything would be fine. It doesn't seem to have worked out that way in our 45-year experiment with a floating exchange rate system. So suppose we said we assumed a scenario where the domestic U.S. economy seemed to call for higher rates, let's say even as high as six quarter-point raises. That would take us to 2%. With the 2% inflation, that would be 0% real interest rates. Think of that. But doing that, which arguably would be better for the U.S., would create a debt crisis in Brazil and other dollar-denominated, deeply indebted places. Doesn't that bring us right to the topic of our conference? Should the Fed not do that because of the debt burden which the rest of the world has incurred, a lot of which is in the dollar? And any thoughts on that? Does that make sense?
I think that's certainly a good observation that floating exchange rates have not been a more stable world. And I think it's because when the initial analysis was done, it was largely focusing on a world in which financial markets are domestic and you didn't have the cross-border linkages that become so important. They've been a great transmitter of shocks. On the other hand, I would point out that as emerging market economies have embraced floating exchange rates, there has been a dramatic reduction in the classic emerging market debt crisis. A country like Brazil, a country like Russia have gone through a huge amount of stress over the past couple of years as commodity prices have crashed, as their exchange rates have crashed, and yet their domestic financial systems and sovereign balance sheets have been fairly resilient. And I think a large part of that is because they do have the exchange rate as a buffer, as well as more sophisticated risk management in domestic financial institutions and in the regulators. So I think we may be in a somewhat different world where the financial stresses are certainly impacting on growth prospects, but where we may actually not see the sort of calamitous events that we were used to 20 or 30 years ago. So even if the Fed does raise rates 6 times over the next 6 quarters or 8 quarters, I don't think that automatically means that Brazil is necessarily going to have a debt crisis. The Brazilian sovereign balance sheet is strong. The debt problems are more focused in the state-owned enterprises, which do have some protection from the sovereign. Brazilian private banks are actually fairly robust. So I think the impact would be substantially absorbed by a weaker exchange rate, provided that the Brazilians themselves are able to turn their own policy environment around. I think that's the crucial thing for Brazil's future, is not what the Fed does, but whether Brazil can actually put in place a strong government that can implement more credible policies, particularly on the fiscal front.
Yeah. So I would say 3 points to that, and the first is, I think Charles is right with the prediction that floating exchange rates would be stable. Was stabilizing was made on when balance sheets were smaller and less complicated, and the national balance sheets have all manner of vulnerabilities across currency denomination and maturity, and that's what you learn when prices change. There are consequences for balance sheets. Second thing I'd say is economies say that national authorities say they're floating a lot more than they actually let their currency float. That the volatility of exchange rates vis-a-vis the volatility of international reserves would make you think that not everybody's Australia and New Zealand. And in that environment, part of the tensions in 2015 were economies shadowing trying to limit the fluctuations vis-a-vis of their national currency to the dollar, unwilling to tolerate the appreciation associated when the other two G3 central banks are trying to depreciate relative to the dollar. So that is an ongoing source of vulnerability. And the third issue in terms of going forward is we've noted this disconnect several times. The Federal Reserve's rate guidance, the dots in the summary of economic projections, have everywhere tracked above what the euro-dollar curve would suggest, i.e. market participants seem to expect a much more gradual path for rates. Implicit in that is either the judgment that the global economy is so anemic the Fed won't get around to raising rates that much, or that there's enough vulnerabilities that the Federal Reserve's attempt to do so will lead them to scale back those ambitions.
Desmond, go ahead.
No, I very much agree with Vince's last point. I'd just say that the ability of emerging markets to use their currencies as much as they would like has to be limited by the fact that their corporate sectors have contracted $5 trillion in dollar-denominated debt. So if you do really allow the exchange rate to move, you'll have a financial crisis. and I'm not sure that I share Charles's view on the health of the Brazilian financial system or of its government finances. You know, we've just seen, as I mentioned, we've already seen debt to GDP on the sovereign side move from 53 to 67% in the space of 2 years. They're running a 10% budget deficit right now. The economy is tanking. Generally, when economies tank like this, you have nice little problems in your corporate sectors, your banks that require a government bailout. When you add it all together, Brazil is probably well on its way to being over 100% of GDP on its public debt, which doesn't bode well. They've got a lot of fiscal tightening to do, and their political environment doesn't look to me like it's conducive. Their whole political class is so discredited. For them to tell the public that they've got to raise taxes now is not going to be an easy sell.
We'll take one more, and then we're going to turn to the audience.
Responding to Desmond, I mean, I don't want it to minimize that Brazil is in a big mess right now. My point is that the sovereign balance sheet is actually long in dollars. So it's different from the past when we had the classic EM debt crises. Brazil's foreign exchange reserves actually exceed the government's external debt, so that it's less vulnerable to large movements in the exchange rate from that source. Now, there are certainly vulnerabilities for the domestic corporate sector because of their dollar borrowing, but at least the sovereign has some capacity to provide a cushion to the corporate sector. But that does mean, however, that you have a more classic problem of debt burden and restructuring that depresses growth for a long time. But I don't think it means you have an external debt crisis.
All right. I think we all just agreed that whatever the Fed is agonizing about and decisions they're trying to make, it would be irresponsible of them not to take these international effects into account. In spite of the fact that, as Vince said when he began, we might not find any authority for doing that in the Federal Reserve Act, which creates and continues them. Let's turn to the audience questions. May I remind you here, wait for the microphone, please, which will come to you. Tell us who you are and what your affiliation is, and then come to your question. Now, if you decide to preface your question by a statement, the chair will give you about 1 minute. If you haven't come to your question in 1 minute, you'll hear that, and that means it's time to ask your question. Yes, we'll start here.
Tip Ghosh, my question goes to Vince's presentation on...
could you tell us what your affiliation is?
Carnegie Mellon University.
Thank you.
So I want to appreciate Vince's presentation on Federal Reserve governance. The question is, the House passed the Form Act in November looking at governance and transparency of the Fed, which really gets to public support of the role of the Federal Reserve. So I guess this question is to the panel. Primarily, the statutory role of the Fed is domestic. So comment on the Form Act and transparency of the Fed.
Okay, you want to start on that one, Vince, since you brought up the statute?
I would first say the discussion, I think there's a serious problem in Fed governance. Importantly, the Congress doesn't do a particularly good job in the oversight of the Federal Reserve. And to do that, just sit through 4 hours of the semi-annual hearings 4 times a year at the House and Senate subcommittees. They don't get to the point. There's not a mechanism to have a uniform discussion of monetary policy. The various bits of legislation that were put forward over the last year or so tell you how awkward it is when lawyers try to draft equations, i.e. the discussion of a Taylor rule as a guiding policy. So I think there's got to be an improvement in governance, but I think it is not just what the Federal Reserve says, it's how the Congress holds the Fed accountable. My own preferred outcome actually would have would write into the into the law the requirement that the GAO does a semi-annual report on the conduct of monetary policy to be delivered the week before the Federal Reserve chairs semi-annual testimony, and included in that are the questions legislators should ask about the conduct of monetary policy. The GAO is a professional, even-handed organization that is striving to satisfy both sides of the aisle, and so that would be a useful way to make what is now a wasted opportunity.
Other comments on that one? I am on record as suggesting a new joint committee of the Congress whose only responsibility is oversight of the Fed. So you could get a committee that actually knew something about what was being discussed.
But by the way, when we also say part of the problem is the mission creep within the Federal Reserve, when you give an independent agency multiple missions, then you wind up not holding it accountable for the one that's probably the most important, the conduct of economic policy.
I would just add that I agree that congressional oversight is lacking in expertise, but also in integrity. During booms, the Congress loves whatever the Fed does. And during crises, they hold these hearings to point the finger. And I think that I don't know if a GAO intervention that you just described is going to change the way in which the Congress holds the Fed accountable for complying with its mandate. But I think this is really where the rubber meets the road, and I would go further in saying that the dual mandate gives the Fed an awful lot of slippery slope to play with in this governance point that you made, Vincent, and it just may not be tight enough, especially when there are questions with complying with the full employment piece of it, and there's no conformity on the price stability point for reasons that we've alluded to earlier. And, and there's a third dimension of this, financial stability, and whether or not that belongs in the mandate. I'm on record as saying that it should. I don't buy the idea that we can trust the Fed to have learned the lessons of repeated crises, and they take financial stability seriously. I think time shows that over time, the Fed and the Congress really don't take anything seriously until they're forced to.
Thank you. Right here, please. It's the younger gentleman there.
Thank you. Bert Ely, banking and monetary policy consultant. First of all, with regard to the United States, Donald Trump has assured us that once he's president, everything's going to be okay in this country. So we can stop worrying about the outlook for the U.S. economy. My question, I hope everybody appreciates that's a joke. My question, and this primarily to Mr. Roach, comes to this issue of the debt overhang and what it takes to resolve it. In my sense of looking at the troubled economies around the world, that a lot of the debt overhang problem really relates to the inability and the delay in resolving essentially insolvent borrowers. I think this has been clearly a problem for years in Japan. It's a problem in China. It's very much of a problem in Italy. So my question is this. When we talk about monetary policy around the world, are national governments and the central banks possibly focused on the wrong issue? That the real issue is a matter of banking supervision and of forcing an earlier recognition of credit losses in the private sector, even though those credit losses may in fact render a lot of banks insolvent.
Steve, I think that goes to your zombie point you were making.
The lesson of Japan is the longer you put off restructuring, borrower insolvency, the more congested the system becomes from a broad macro structural productivity point of view. And the Japanese still haven't really learned that lesson. I would argue that central banks, by staying extraordinarily accommodative for extended periods of time, just they do their share in kicking the can down the road, and a little tough love on the part of the central banks from the standpoint of normalization without throwing the system back into a into a hole, and that's realize almost an impossible thing to do. That would go a long way. I don't think we're going to come to grips with this debt-intensive expansion in any system, whether it's China, Europe, the United States, or even Japan, at zero interest rates. It won't happen. And that's a consequence that we need to address.
Anybody else? Desmond?
Yeah, I guess the point Steve is making is really very relevant. What I'm concerned about right now is in China, instead of learning from the Japanese mistakes, it looks like what the central bank in China is doing is allowing yet another burst of credit expansion. The first quarter credit expansion is up by something like 40%, even though they've clearly got problems with corporates with excess capacity, with bad loans and all the rest. They just seem to be pumping it up some more.
Thank you.
Gillian Garcia, international financial consultant. Stanley Fischer, the deputy chairman, when he was at the IMF, argued that the IMF should be the lender of last resort. I think the panel mentioned the IMF just once during the last hour and a half. Is there a role for the IMF here?
Thank you. I'll take that, Charles. I think you talked about the IMF.
I did mention the IMF, and I think there is a role. There is a missing instrument, so to speak, in the global international architecture right now to provide short-term liquidity to countries facing a period of market stress with easy access without intrusive conditionality. I think the Fed has the greatest capacity to fulfill that role. But the reality is, as I argued before, that the Fed is really not going to be in a position to play that role. Because it would force it to choose between winners and losers among countries, which is a difficult position for the Fed to play, and because there would be political resistance on the Hill to the Fed taking on those risks. So I think there is a place there for the IMF. The IMF does, of course, provide financing to countries in problems with conditionality. However, it does not at this point have a facility to provide this very short-term liquidity. And that's been discussed quite intensively over the past few years, particularly since the global financial crisis. But up to now, there hasn't been a strong support. And in fact, the United States has resisted that notion, in part because the Fed is reluctant to support such an approach. But I think that's an area where there does need to be some rethinking.
Leaving aside questions of practicality and moving into the realm of pure theory, we got any supporters on the panel of John Maynard Keynes' idea of a true international central bank, which is not a national central bank, which issues a currency which is not a national currency? No supporters.
In the next millennium.
No, I guess what would give me pause is the International Monetary Fund's lending record, when they were able to use vast amounts of money in excess of the normal credit lines. So I look at their balance sheet, and in the balance sheet, countries that feature prominently right now are Greece, Portugal, Ukraine. None of them that can really be called success stories. So I'm not sure that I want them to have the lender of last resort, but maybe that's because I know too much about the institution.
So just my quick answer to your question, Alex, is Bitcoin. So that may be our future, but fundamental to all this discussion is about governance issues. Congressional oversight is poor because an agency is primarily created to provide insulation between the Congress and voters. If you were talking about governance issues, then they come in multiples at the IMF. And so as we think about expanding the role of any institution, we also have to figure out how to put some protection to that institution. And so without reform of the board at the IMF, not confident in giving it a pot of money.
Yes, over here.
Thank you. Matt Marcevich, I'm a financial analyst. Quick question. So when we talk about this massive debt growth, I think the elephant in the room is debt's grown at about twice the rate of GDP globally. And that was the McKinsey report that was basically Q4 2014. When we look at that amount of debt trying to prop up the worst growth in history, when we look at balance sheets, and when I talk balance sheets, I'm also talking pensions, et cetera, underfunded but invested in companies that are levering up as well. Is it realistic to assume that we can have a rate rise without crushing everything, A? And then B, the elephant in the room as well, two elephants, is that central banks are remitting a lot of money to governments right now. So if you look at us, it's about, what, 90 billion? So there's already talk of cutting the Fed dividend and using that for infrastructure growth. Where are we going to come up with 90 billion? And we look globally, like the SNB, Swiss National Bank. They've printed so much money, they're buying equities now. Japan's buying equities. What are your thoughts on this? And when we look at bureaucratic mission creep, do you really see an end to this?
I'd like to take up something there.
Worked on the Geneva World Report on deleveraging about the same time as the McKinsey report, and our concerns were we didn't see any deleveraging anywhere, and that the rise of corporate leverage comes to the fundamental problem that private mistakes become public sector obligations at a time of crisis. So even economies that have better fiscal positions have a contingent exposure. So that's a source of concern, and it is therefore raises the serious questions that a few of the panelists have introduced, and that is, how are central banks ever going to raise rates if it so increases debt burdens? Just do the CBO, look at the CBO alternative simulations as the Fed begins to renormalize interest rates. That is consequential for the global economy.
All of this might be the consequence of the policy approach that we chose, that rather than having a fiscal stimulus that would have been targeted, could have been limited, we instead engaged in this central bank balance sheet expansion that went on so high, encouraging people to take inordinate risks, encouraging a huge amount of lending. Maybe that is the lesson that we should reflect on, that we really don't want another round of quantitative easing that would really just bump up all of these balance sheets. But I share the concern. I just don't see how the Fed can engage in serious interest rate normalization with all of this debt around the world. So I don't see it as actually occurring. Sure, a lot of the stuff would come back.
Yeah, and I add Bert's observation to Des's list, and that is acknowledging previous mistakes. Financial crisis is an enormous destruction of wealth. You got to do three things. You have to admit that you lost wealth, then you have to allocate that wealth loss across your citizens, and then to the extent you can use other policies to offset the effect on the macroeconomy, you do that. And the experience of Japan, the U.S., and in the euro area tells you that officials can have varying degrees of success in doing that.
Yeah, but
A good
this
cr-
gets back. I mean, again, this gets back to basic political economy issues. We're utilizing financial engineering to create artificial growth, and we don't want to change the social contract with our between politicians and voters to provide less in the way of artificial growth to them, and if anything, that continues to be perpetuated all the more in a low inflation, low interest rate in environment. And so I really think that this political season that we're entering into, whether we want to or not, is going to address these social contract issues, at least in this country, and given high levels of structural unemployment amongst young people in Europe, and this outbreak of potentially very dangerous populist sentiment all over the world, whether you're building up walls or blaming China, we're I think that's the topic here is sort of a rather seemingly technical issue that bears very directly on critical political issues that we're all facing right now that we somehow are not prepared to really own up to.
As a good example of the problem Vince cited, of the difficulty of facing up to the problems, and Steve's social contract we have not far from home, Puerto Rico, and the vast difficulties of trying to face up to the losses. Where I disagree with you, Vince, is you said all this wealth is going to be destroyed. My view is the wealth was never there in the first place. It was an illusion of the market in the first place, or of the central banks and the market. And so what we're doing is just going back, is taking away the illusion that the wealth was there. But that's still hard to do, I readily admit.
The reason we're talking about central banks and central bankers is it was the only moving part in the political system. I often talk about service comedies of the 40s and 50s that had the same scene where the officer comes in and says, "Man, I want you to line up for a dangerous mission. You probably won't come back alive, but your nation will thank you. Please take 2 steps forward." And everybody takes 2 steps backwards except the hapless hero, who is exactly the person who doesn't have the tools to successfully conduct the mission. And in this particular case, the hapless hero is Ben Bernanke.
Yes, here.
Yeah.
Thank you. Thanks for your presentation. My name is Li Yang. I love the global citizens idea. I just wonder if you can address first whether Fed should exist or should be abolished. And if they should continue to exist, whether you can do something. One is to ask the financial institution, which usually go with the other sector too, to really restore their credibility and then distribute their earnings or revenues to the asset or account holder according to their share of capitals or their assets in the bank. Second, it will be like whether you can really restore the credibility of financial institutions, really look into their data, and really looking into their foreclosure settlement. A lot of settlement is only account number, but not really prosecution. So that eventually those money will be also robbed by somebody. So I just wonder if you can really ask the maybe cooperation with the Department of Justice or White House or Congress really prosecute those financial institutions, those not only they take people's money, they really use unlawful act, unlawful, and maybe very criminal too. very strong. I'm in very strong language.
Okay, thank you. Well, the first part there, we have the most radical question of the day so far. Should we abolish the Fed or should it be continued? And how should whatever wealth it has relate to the banking system? Anybody want to take something there?
A highlight of having to sit behind Chairman Greenspan for semi-annual testimonies was when he would have to testify before what was then the House Banking Committee, and have a 5-minute exchange with the then congressman from Vermont, Representative Bernie Sanders. And a favorite of Representative Sanders was asking Chairman Greenspan why he continued to advocate sunsetting all government agencies. And the chairman's answer always would be, it's an opportunity to revisit the mission of the agency, and you could better focus the ones that exist and eliminate the ones that don't. Talk about creep. Agency creep is pretty severe in Washington. So I would say I'd be perfectly comfortable sunsetting the Federal Reserve, because when Congress has the discussion, they're going to conclude they really do need a central bank.
This reminds me of a little bit of Federal Reserve history, which I may remind the audience of. In the original Federal Reserve Act, the Federal Reserve banks did have a sunset. They had limited charters of 20 years. And so from 1913 to 1933, the charters of the Federal Reserve banks would all have run out. Would have been interesting timing, but they decided to give them perpetual charters instead in 1927. I have a question over here. Yes.
Hi, my name is Dimitri. Thank you very much for your presentation. My question is just about central bank cooperation.
Can you give us your affiliation, please?
I have no affiliation. I'm independent. I'm just wondering if you could talk about central bank cooperation. Do you see it increasing recently, and your projections going forward? I mean, there was the talk of the currency wars before. Is that still ongoing? Is that increasing or decreasing? Thank you.
I think central bank cooperation is really pretty intense. Through multiple channels, including in Basel. The G20 has I think, played an important role in broadening out the discussion. I think that's really the key question going forward. Can we broaden out and diversify effective cooperation from beyond the limited circle of G7 central banks to a much broader range of central banks, including the major emerging market countries? And I think the big advance in Shanghai was that the PBOC really began to behave in a more internationally responsible way, seeing that the international consequences of its actions as well as the domestic consequences of its actions. But now hopefully that will be sustained by the PBOC. But I think going forward, what would be excellent is if we continue to extend the group of central banks that are buying in to a basic commitment that the G7 central banks have adopted for the last few years to conduct policy in a way that, while it's directed at domestic objectives, also takes into account the broader international implications. And I think that would be tremendously beneficial for the stability of an international system at a time when the emerging markets, even though they're growing more slowly than they have in the past, they are nevertheless growing substantially faster than the mature economies and are correspondingly taking up a larger and larger share of the global economy.
Can I just add?
Yes, please.
Can I just add one thing to that? Charles is on to something really important. I spent a lot of my time in China, and I don't think this was like the PBOC just all of a sudden waking up and say, it's time for us to be adult and responsible. They were put under a lot of pressure by the capital flight and by the possibility that the world's greatest cushion of currency reserves would not be enough to enable them to, keep the miracle alive. And I just think this is an example of what happens when the authorities are actually put under pressure. They do behave more responsibly, and they can sometimes take that message to then do the heavy lifting that needs to be done in addressing some of these tough underlying problems. And I think that's a very important point to also take out of what happened in this difficult period earlier this year.
We have, at this point, come near to our hour of adjournment, and we're all picturing everybody else stepping back except the Fed as the maybe reluctant and necessary world central bank. I'd like to remind you all, if you're interested in questions of the Fed, this coming Monday evening here at AEI, there is another Federal Reserve conference, this one on the new and highly provocative book, The Power and Independence of the Federal Reserve by Peter Conti Brown, and the author and commentators will be here Monday night. And then early in June 8th, I think, Desmond and I have another conference on the Puerto Rican debt crisis you may find interesting, which should be even hotter by then than it is now. Let me thank you all for coming and thank our excellent panel. And we are adjourned.